What's going on, YouTube? So, today I'm going to go into another stock I may purchase, but stay tuned to the end to see if I really purchase this video and like and subscribe to my video. Now, I'm coming towards the end of finishing building out my dividend portfolio for my bridge account. So, if you don't know what a bridge account is, here's the definition on the screen. But to sum it up for you, it's just an account to help me pay for pre-retirement expenses if I want to quit working. Plain and simple. Now, I want it to be passive income. Now, I really only believe there's two types of passive income, and here's a video of someone talking about it so you understand my point of view.
Income exists. I think the reason so many scum buckets are making so much money is because you're buying stupid courses over and over, thinking there's some magic formula for passive income. Passive income looks like this. You take money that you can afford to go to zero, and you put them in the two places that have historically created passive income. Public markets that you don't care if it goes up and down and you just wait to the end, or real estate, and you hope that your real estate area doesn't get crushed. Everything else almost does.
So yes, I only believe that is the two real passive income out there. And at the end of the day, I'm not here to try to scam you or do anything or sell you a course. I'm just showing you my portfolio, the steps I took to get to it. Now, I read the book by Ben Graham, The Intelligent Investor. And I listened to Warren Buffett and Charlie Munger. And Warren Buffett had to say this about the intelligent investor.
The intelligent investor. And from that point, I never bought another stock. I bought businesses that happened to be publicly traded. But I became an owner of a business. And I did not care whether a stock went up or down the next day or the next week or the next month or the next year. And I didn't have any idea what it would do. I didn't know what the stock market would do, but I knew businesses.
Now that you know the concept of what I'm doing and why I'm building it, I'm going to tell you my requirement for my dividend portfolio. Now, I still need to do my due diligence on it, and you need to do your due diligence because I'm not a financial expert. I do give financial advice, but I'm not your financial advisor. So, at the end of the day, this is my portfolio that I'm building for my bridge account. So, I have different requirements. My first requirement is a dividend paying stock for the passive income. My second.
Never buy a stock that doesn't pay a dividend. That has been your advice through and through. Why are these stocks more attractive?
You look at companies that don't pay distributions, don't return capital, how risky they are. Take a GoPro, for example. I'm not just picking one company. I'm just giving you a good example of a company that basically has lost 70% of its value, never returned a dime to shareholders. Or how about a company that's been around much longer, Yahoo? Never paid a dividend. It's never made money for anybody except all the CEOs that have gone through there and got whacked.
One is they had to have decent performance over the last few years so that I have built a growth dividend portfolio. Number three is they have to be financially secure, and I have to do research on them, see why and where the cash has been going so I have a better understanding. And number four, I have to want to have ownership in the company and see a future of having the company. Now, let's get into the stock. Stock I'm looking at is Diamondback Energy. Diamondback is an independent oil and natural gas company, and it's in Midland, Texas, focused on acquisition, development, exploration, and onshore natural gas. They're in the oil and gas and energy sector. So here's a video about Diamondback Energy.
Diamondback Energy is an independent oil and natural gas company headquartered in Midland, Texas, United States. The company focuses on the acquisition, development, exploration and exploitation of onshore oil and natural gas reserves in the Permian Basin in West Texas. The Permian Basin is considered one of the largest sedimentary basins in the United States. Diamondback Energy began operations in 2007 with the acquisition of 4,174 net acres in the Permian Basin.
So you can have a better understanding about them. I could go on the website and learn more about it, but I found out over the years and months of doing this, it is best to just go to Wiki to get the summary of it. You don't want to make it too complicated because once you make it complicated, it gives you a headache and it's just not worth it. So here's the basic summary about Diamondback Energy. The headquarters in Midland, Texas, an American company engaged in hydrocarbon exploration in the Permian Basin. So as of December 31st, 2024, the company makes 3,557 million barrels of oil equivalents. Okay. And they're pretty diverse. I like that. They have 49% estimate in reserves was petroleum, 24 was in natural gas, and 27% in natural gas liquid. And they rank in the top Fortune 500 at 383. So they're up there. And here's the other thing I like to see is the revenue went up, the operational income went up, net income went up, total asset went up, and total equity went up. So they have a few lawsuits out there. They have a few things going on. But at the end of the day, almost every energy company, oil company gets sued all the time for environmental. So I don't ever worry about that. But that sums up Diamondback Energy. It's just a company that deals with electric, water, gas. It's an energy sector. So that sums it up. So let's get into this Diamondback Energy and see how it's been doing. So year to date, it's down 12.33%. And I understand why after I read the news. And 1 year is down 18.22%. 3 years is down 6.62%. And 5 years is up 453%. Okay. Almost every energy company is having the same issue. They have dips right now in oil and gas. And I understand that. But let's see the dividend income. The dividend is 2.79% with the annual dividend limit of $4. And they pay out quarterly, and that's good to know. And the issue we have now is the dividend growth is negative 63.7%. And the growth year is 1 year. But they consistently paid out, and that's what I look at. They didn't cut dividend, but they did lower the pay. So if you're looking for dividend growth, this isn't a stock for you. But I'm not looking for dividend growth. I'm looking for a company that pays dividend that has a decent performance or have good prospect of growing. So let's go into the finance. It pays dividend. The performance in the 5 years is 453%. I do like that. Now, if I look at short term, the performance is not that great, but I'm mainly concentrated on long term. So the finance. Over the years, the revenue grew, and it grew 31.55% last year. I do like that, the growth. Now that I know it's growing, I want to see what is my margin, because that's the biggest thing for me. Is this company making money? If it's not making money, then I don't want to buy them. And the gross margin on this one is 71%. That's outrageous. That's really good. And that makes me say I might want to buy them. So the net profit is 33.44%. So they have a great profit margin, and that's what I like to see. So the analysts, or let's go back to finance. The balance sheet shows that it has 2.11 billion asset, and fixed asset is 65.18 billion. So they're worth about 67 billion. And let's look at the current liability and long-term debt. They did increase the long-term debt, but I read up on them and figured it out. They did a major expansion last year, and they used almost all their cash to do so, to meet the requirement for, guess what, AI and the electric needs of the United States. So they have a 4.81 billion and 12 billion in long-term debt, which equals out to 18 or 16 billion, which their fixed asset and current asset is well above that. So I can forgive them for increasing to do a expansion. Now, here's the thing. before the expansion, how were they doing? Now right now they have a negative 5.37 billion, but that makes sense according to the balance sheet because they increased the debt by $6 billion. So that makes sense why they're in a negative cash flow last year. But prior to that, they're in the positive billions in cash flow. So I expect them to recover from this. Yes, they increased their debts, but they did it for a major expansion. And this is probably the best time for me to look at trying to purchase something like that. So let's see what investors are in them so we can have a better understanding. Asset management, investor, true. Okay, they have decent amount of people. Top seller. Who's selling this company? No one I really know. So it looks like they do have some insider sellers, but that's fine. But here again, they're energy and they're in oil and gas. So now let's go into what AI thinks about them, so we can have a better understanding. Valuation is 4 out of 6. I do agree with the valuation. They're doing pretty well compared to the competitive, and that's good. Now the earnings. It is a 1 out of 6. And I do agree with that. Their earnings has declined because of how much they spent on expansion. So the earning is not that great. Now, future growth is 4 out of 6. And that's not that bad. I agree with the number. Historical performance is 6 out of 6. And I agree with that. And financial health is a 3 out of 6. And I agree with that too. So, will I be adding this to my portfolio? Well, I'm going to tell you right now, like and subscribe to my videos if you like these type of videos. But yes, I will be adding this to my portfolio. Why? Because the historical performance is a 6 out of 6. And the future growth is 4 out of 6 based off AI. And I knew that they spent a lot of money expanding to other areas for oil and gas. And that is highly needed right now. So, and the valuation is 4 out of 6. So, based off the data I saw, their revenue's going up, they're getting back in the profit margin, and right now it looks like it is a all-time. It's going down. But I'm trying to buy stocks when they're cheaper and not on the high end, and that's what you have to understand. Now, the analyst does give this a strong buy. And personally, I agree with them on this one. And that's why I'm buying this stock. Because I agree with the analyst on this one. It's a strong buy because they did an expansion and they just waiting to collect money now. Now, if it was prior to that or last year, I would not have bought them because they were spending money on expansion. And I know when people see the revenue expenses go up, they're gonna say, oh, they're costing us money now, and sell the stock. But in the long run, I think this stock will be good, and I'm gonna add it to my portfolio. So that's all I got for you.